We're not far away from November and tax loss selling. And of course, often we see shares that have come down for the year come down more because investors sell them to lock in a tax loss to set against their gains. Let's get some thoughts from Sid Mokhtari, Chief Market Technician at CIBC Capital Markets. Sid, thanks very much for joining us. We're certainly getting an early start on this one, but fascinating because you highlight a bunch of stocks here that are down. And of course, it's been a good year, so people may have a bunch of capital losses they want to offset. Or sorry, a lot of capital gains they want to offset.
Precisely. I mean, thanks very much for having me, first of all. I do agree that this has been a very robust year for the TSX index. As you mentioned, breadth has been very strong. So we have had a broad base, call it, in so many areas of capital gains. So 2025, by many definitions, does have a lot of good capital gain backdrop. That this harvesting strategy, call it tax loss selling strategy, may be viable narrative. In our opinion, it is. We have tested this in the past, and it has worked quite well.
So I guess one idea here would be you like the look of a stock longer term. You wait for it to get dumped in tax loss selling, and you can pick it up relatively cheaply.
That's very true by some measure. We also have a formulaic approach. We always have to start with, by some measure to make sure that we can historically go back and test it to make sure that it does have validity from that perspective. Mm-hmm. And we have found that, at minimum, your stock needs to be 20% down from its 52-week highs. It needs to be negative for the year. And to your point, we also measure stocks that are down on the quarter, and and also rank poorly in our matrix process. So we certainly want to make sure that when it's a tax loss candidate, it does have a negative momentum, negative trend. All that should be able to provide that, call it, potential weakness into the month of mid-October through to mid-December. While noting that bulk of tax loss pressure kind of peaks by mid-November and into December, and that becomes, call it, a good opportunity for bargain hunters, if you will.
Sorry, give us the timing. When do we tend to see the peak tax loss selling? I know it's hard to be precise.
Absolutely. There's no real, but anecdotally, we know that by mid-November through to mid-December, bulk of the pressure has occurred by then. And it's referred to as tax loss selling period. And there's the repurchasing period that begins from, call it, mid-December through to onward into January.
Let's have a look at some individuals here. We'll start off. Our first group is headed by TFI International, the trucking company. Now, these five numbers: Ag Growth, the maker of farm equipment, Air Canada, Cargojet, and Docebo, the software supplier. They're all rated by your analysts, but they're all down quite.
Absolutely. I mean,
sorry.
No dispute. I mean, no, you're absolutely right. I mean, we sort of want to stay agnostic of what is perceived to what measure, either fundamentally or technically or quantitatively. We certainly want to make sure that it does qualify from a tax loss selling perspective. And those names they have fallen into, call it, from their peaks are down 20%. They have negative momentum. They're down on a quarter. They are ranked poorly in relative strength. So I think they could be qualified as tax loss members, which we have done this test in the past decade, and the results have been, successfully viewed from the perspective of, okay, let's maybe use them as a, harvesting strategy against our capital gains, and then revisit them as we go into the repurchase period.
And let's move on to another group. Again, these are stocks that are down a lot this year and are rated by your analysts. Quite a few software companies: Lightspeed, Constellation down 14%, West Fraser Timber, CGI. Interesting, CGI and Constellation, long seen as reliable blue chip growers, but they have fallen out of favor lately.
I think those two are quite attractive for us, in our opinion. We talked to a lot of clients out there, and many agreed with us that they are compounders, as you said, very well owned by many managers out there, either on the institutional side or on the retail side. And they both are great names, and like I said, because it's been a great year and because so many people own those two names, why not, use them as a tax loss, harvesting strategy? Those two are actually quite prime, in my opinion, from the perspective of tax loss selling. We would be inclined to review them when we get into the repurchasing period window, and I think they will become quite attractive at that point. But at this point, I think they may be susceptible to tax loss selling, in our opinion.
Yeah, it is fascinating. Okay. I'm just trying to think, Sid, we're almost out of time, but over the holiday period itself, trading can become very illiquid, and sometimes it could be a good time to put in a stink bid for a good stock and get it cheap.
I think it's historically been, as to your point, a great strategy. And this year we only have 32 members so far. And by historical measures, we usually have about 50 to 70 members from a tax loss perspective. So the number is pretty limited. And like I said, it's a good opportunity this year, just given how many managers are in the money, and capital gains are plenty right now. So it would be reasonable to assume some of these large cap compounders that are coming under pressure may be used as a tax loss candidate, but provide great opportunity as we go into the repurchasing period.
Sid, fascinating stuff. Thank you very much indeed. Sid Mokhtari joining us there, Chief Market Technician at CIBC Capital Markets.